Good day. I would like to enter into a lease contract with your company. I have my preferred lease arrangement where I can use the asset for my operations during the lease term.
Alright, let us review the details of the lease agreement.
Welcome to Aquila Transport Corporation. We offer leasing services for specialized delivery trucks. This lease agreement covers a 6-year term with 1,200,000 annual payment, which is payable at year end with a 9% implicit rate, including a 300,000 pesos lease incentive and 500,000 pesos residual value guarantee. The asset useful life is 8 years, which extends beyond the lease term. Moreover, the Orion Company incurred 120,000 for initial direct cost and obligated to restore the asset at present value of 250,000 as of January 1, 2024. However, as of January 1, 2027, they decided to extend the term for 2 years, thus increasing the annual payment to 1,300,000 and leading to revised incremental borrowing rate of 10%. These are the following key issues. First, proper application of IFRS 16 leases, including correct recognition and measurement of lease liability and right of use asset. Second, accurate treatment of lease incentive, residual value guarantee, initial direct cost, and restoration obligation to avoid misstatement of assets, liabilities, and expenses. And lastly, correct accounting for lease modification, including assessment of remeasurement and use of revised discount rate. At this juncture, let's analyze the agreement. First, let's classify the type of lease. Upon considering the lease term, which is 6 years, covers a major portion of the asset's useful life. Also, substantially all risk and rewards of ownership is transferred to the lessee. Thus, we can say that the agreement represents finance lease lessee accounting. Second, let's compute the initial lease liability. The initial lease liability is determined by discounting all unavoidable future cash flows at 9% implicit rate as of commencement. This includes the present value of the 6th annual payment of 1,200,000 and the present value of 500,000 residual value guarantee, resulting in total initial lease liability of 5,681,235.97. Third, let's compute the right of use asset. The right of use asset starts with the lease liability and then adjusted for other initial measurement items. The 300,000 lease incentive is deducted, while 120,000 initial direct cost and the 250,000 present value of restoration obligation are added. After this adjustment, the initial right of use asset is recognized at 5,751,235.97. And for the journal entry at commencement date, January 1, 2024, we debit right of use asset 5,751,235.97, lease incentive receivable 300,000, credit cash 120,000, lease liability 5,681,235.97, and estimated liability for restoration cost 250,000.
This part discusses the subsequent measurement of the lease, which includes the lease liability, restoration cost, and depreciation of the right of use asset and their journal entries. For the amortization of the lease liability, the schedule shows the payment, interest expense, principal, and present value. The initial balance on January 1, 2024 is 5,681,235.97. The interest expense is computed by multiplying the outstanding balance by the implicit rate of 9%. Given the annual payment of 1.2 million, the principal is determined by deducting interest expense from the payment. This principal is then applied to the previous balance to arrive at the new present value. As the balance decreases, the interest expense also decreases each year, reducing the lease liability to 3,423,645.34 by the end of 2026. Next is the annual interest expense for the restoration cost. The obligation starts at the present value of 250,000. Since settlement occurs at the end of the lease term, the balance increases annually due to interest accretion, computed by multiplying the carrying amount by the given rate. This continues until the liability reaches 500,000 on December 31, 2031. Lastly, the right of use asset is depreciated by deducting the 500,000 residual value from the total cost of 5,751,235.97 and allocating the remaining amount over the 6-year lease term, resulting in an annual depreciation expense of 875,206. Finally, the journal entry presented corresponds to the year prior to the lease modification. Here is for the 2024, for the 2025, for the 2026.
Lease modification. First, let us determine whether this lease modification is accounted for as a separate lease or a remeasurement of the existing lease. For this specific case, the lease modification is accounted as a remeasurement of the existing lease. Now, let us compute. The annual payment increase is multiplied by the PV of ordinary annuity at 10% for 2 periods, which is equals to 2,256,198.35, and then it is multiplied by the PV of 1 at 10% for 3 periods, which is equals to 1,695,115.21. Now let us compute for the PV of original lease payment and the new PV of residual value guarantee. let us start with the PV of original lease payment, whereas the 1,200,000 is multiplied by the PV of ordinary annuity at 10% for 3 periods is equals to 2,984,222.39. And then the new PV of residual value guarantee, whereas the 500,000 pesos is multiplied by the PV of 1 at 10% for 5 periods, which is equals to 310,460.66. Let us add these three, the PV of new lease payment, PV of original lease payment, and the new PV of residual value guarantee, which amounts to 4,989,798.26. Now, to compute the increase in lease liability, the new PV of lease payments is subtracted by the carrying amount of the lease payments on December 31, 20x26, which amounts to 1,566,152.92. After that, let us add the carrying amount of the ROU asset and the increase in lease liability, which amounts to 4,691,770.91. After computing for the new PV of lease liability, let us get the amortization table for it. For the first 3 years, the annual payment is 1.2 million because this is the remaining payment from the original stipulation. And then, for the lease modification for the extension of 2 years, the annual payment is 1.3 million. To compute for the interest expense, let us multiply the PV with 10%, and then subtract the interest expense from the annual payment to get the principal. After that, let us deduct the principal from the previous PV to arrive at the current PV. The journal entry for lease modification. Debit right-of-use asset 1,566,152.92 and credit lease liability 1,566,152.92 to record the increase of right-of-use asset.
As leases reach the end of their term, it is important to properly account for the final settlement of lease obligations and the recognition of related assets. End of lease accounting ensures that any remaining liabilities are settled, residual value guarantees are addressed, and the ROU asset is fully depreciated or disposed of, providing a clear and accurate reflection of the company's financial position. The depreciation of the right-of-use asset is computed using the new carrying amount of 4,691,770.91 less the guaranteed residual value of 500,000, resulting in a depreciable amount allocated over the remaining 5-year lease term. This gives an annual depreciation expense of 838,354.18. At lease end, the company settles the restoration liability of 500,000 by debiting the liability and crediting cash. The right-of-use asset is then derecognized by debiting accumulated depreciation of 4,191,770.91 and the lease liability of 500,000 and crediting the ROU asset for 4,691,770.91, thereby closing all lease-related accounts. Lease significantly affect the financial statements, thus it is important to understand how each component works. First, lease incentives reduce the right-of-use asset because they lower the cost of using the leased asset. However, they do not reduce the lease liability since the obligation to make lease payments remains the same. This results in lower total assets while liabilities stay unchanged. Next, a residual value guarantee is included in the lease liability because it represents a potential future payment at the end of the lease. This increases the lease liability and leads to a higher interest expense over the lease term, affecting both the statement of financial position and the income statement. Lastly, in a lease modification, the lease liability is remeasured based on the revised lease terms, and the right-of-use asset is adjusted accordingly. No gain or loss is recognized because the lease continues under updated conditions. Overall, these adjustments ensure that these transactions are properly reflected in the company's assets, liabilities, and expenses. Lease accounting reflects the true economic impact of leasing on a company's financial statements. On January 1, 2024, Aquila Transport Corporation entered into a lease for delivery trucks, initially recognizing both the lease liability and the right-of-use asset to capture the obligation to make payments and the benefit of using the trucks. Depreciation allocates the cost of the ROU asset over its useful life, while interest expense reflects the financing cost of the lease. As lease payments are made, the liability is reduced, and any lease modifications or remeasurements adjust both the liability and the ROU asset to keep the balance sheet accurate. Lease incentives reduce the ROU asset without affecting the liability, and residual value guarantees are included in the lease liability and affect interest expense. Together, these treatments ensure Aquila's assets, liabilities, and expenses reflect the real financial impact of leasing, providing transparent and reliable information for decision making.
Here is the lease contract. All of your prepared terms are included. You just need to sign the agreement.
Thank you. I agree to the terms of the lease.